I'm being joined on the program by the head of research, UBA Capital, Abiola Razak. Thank you so much, Abiola, for joining us this morning. Well, how was it? Holiday?
Yeah, good.
Everybody rested well?
Well, yeah. And I think it was another opportunity to actually join families and friends.
So in your opinion, now that everybody's coming back from the holiday, what do you think the markets are going to look like?
I think the market is actually going to pick up from where we closed on Monday. Both the equities market and the fixed income markets. And I say that because the market resumed on what I call a twin positive news. The first one is the resolution of the U.S. fiscal shutdown, which I think you've dealt with significantly this morning. I say that because of the fact that Nigeria is more and more open to the global markets, particularly when you look at it from the perspective of foreign portfolio inflows into the country. Say, for instance, if you look at the little savings we've actually had this year in terms of foreign reserves, I think it's largely on the back of the foreign portfolio inflows, both to the equities market and the fixed income market. On the back of that, I think now there's somewhat clarity on the U.S. fiscal regime, even though for me, I think this is not over yet. I think there's still a lot of things to be sorted out. The Obamacare is still there. I'm not too sure of how Republicans would accept this defeat, in my view, quote and unquote.
Is this so much of as a defeat or so much as a conceding to, because they really were on the brink of an abyss, because it was almost a little scary. There were jitters all over the markets. If this hadn't come through, there would have been big trouble.
Yeah, which is why I said defeat, quote and unquote, from the Republican side. I think what the Republicans are saying, there seems to be some genuine arguments, but of course I think we should also look at it from the context of the global markets. We should look at it from the context of the circumstances surrounding the U.S. market as we speak now. Particularly that I personally, and maybe this is very personal again, I'm more worried with respect to the emphasis that is laid on Obamacare. There are a lot of things to deal with. Definitely, Obamacare, perhaps the funding might need to be reduced, but of course we also have to look at it from the perspective of people's ability to pay for their health bills, and of course this is something very important. It's like a basic need of life.
Okay, so now let's come back to our issue for today, which definitely all of what you've just said actually affects. We're talking about the bond market. Well, a lot of people hear about it all the time, but I don't think a lot of people understand what really the bond market is all about. Okay. So could you just, clarify, just give us a little more clarity on what the bond market is all about?
Okay. Just like the equities market, which I think people understand more, which is where you typically buy and sell shares in the secondary market. Of course, that gives you some ownership of a particular company that you buy into. Say, for instance, I buy UBA Capital PLC, which I work for, is listed on the Nigerian Stock Exchange, and let's assume you buy, say, for example, 100 units of UBA Capital PLC shares. By implication, you become a part owner of UBA Capital to the tune of the units that you hold of our shares. The same thing applies to the debt market, but in this sense, the bond market is the debt market, while the Nigerian Stock Exchange is where you trade the equities for part ownership in a company. But of course, a company or a public sector, either the state government or the federal government, can also issue debts. Okay. And of course, debt is just like the typical way you say, I want to raise funding through debt. Right. And of course, the bond market is where you can then participate in that, either the secondary market or the primary market. For instance, you just mentioned that the DMO, which is a debt management office, is coming up with another issue, wherein by tomorrow we expect that the DMO, having indicated last week that they would actually be reopening the 3-year bond as well as the 20-year bond. And of course, we expect that they will issue about 25 billion of the 3-year bond, which is the 13.05 FG in August 2016. And of course, we also expect the reopening of the 2030, which is the 20-year bond. Right. Of course, that's the market where you can actually participate, and also what I call to be, say, in a layman term, say, you can lend money to the government. I've got excess. Of course, I know this is a risk-free instrument. Risk-free in the sense that the government is the most credible obligor, quote and unquote, even though we're beginning to see the U.S. fears of a default from U.S. Over the past 2 weeks now, which hopefully has been resolved. Perhaps some people say we're just moving the goalpost. But of course, like I said, the debt market is where you can actually borrow money either to a company or to a government.
Okay, but from what you've just said now, the bond market is more like a long-term, the medium to long-term kind of thing.
Correct.
Unlike what you have at the equities market.
The equities is actually a long-term investment.
Okay.
The difference is the fact that in the bonds market, you have the longer-term horizon instrument. Equities doesn't have a tenor. Bonds have tenors. The short term of the debt market, rather, is the treasury bills, which of course are also debt instruments, but they mature in less than a year. For the bonds, they mature in more than a year, and that's why, for example, the shortest end of the curve today in the bond market is a 3-year instrument. Yes, we have some maturities before 3 years. For example, even the latest opening of the latest issue of the 3-year bond, which is the August 2016, the term to maturity, yes, we call it a benchmark 3-year instrument, but the term to maturity is actually less than 3 years because it was actually opened in August 2013. So now we've already have about 4 or 5 months into the maturity of that instrument, so it's actually less than 3 years. And of course, we also have some instruments that have been issued before now. For example, the erstwhile 3-year benchmark instrument has just about a year to maturity now because it's maturing in 2014.
And so investors are going to be raking in plenty of profit on that as well.
Not necessarily profit. The typical thing that happens is because it's a tenured instrument. And what I mean by tenured instruments is the fact that there is a maturity over it, unlike equities. When you buy equities, there's no maturity over it because we believe that the company has what we call going concern. And when a company is into going concern, the implication is the fact that you don't expect that company to fold up or to liquidate, even though there might be some acquisition, there might be mergers. You might sell your stake, for example, to the secondary market to another investor who is interested in putting money into that company. But of course, there is no maturity period when the company then begins to pay you back whatever you've invested in the company, except by way of dividends or any other form of special dividends that might be paid to return money back to the shareholders. But in the bonds market, you typically, when you invest in, for example, a 3-year instrument, let's assume you buy into this upcoming offer that we're expecting tomorrow, and you buy the 3-year benchmark instrument, which is the August 2016. The implication is that by August 2016, when it matures, you would actually be paid your principal, which of course is the amount that you invested. Let's assume you invest up to the tune of 1 billion. And let's assume that the implied yield on that instrument is, say, 13.05. In the secondary market now is sold at par. The coupon on that instrument is 13.05. And the implication is that on a biannual basis, the government pays you the coupon, but they will not pay you the principal. But by maturity in August 2016, you then get your principal, which of course is the bullet payment. If it's an amortized bond, you typically get, as you get the coupon on a biannual basis every 6 months, you also get a part of the principal if it's amortized.
Right.
But the FGM bonds are not amortized.
But we see that despite all of this, it seems as if our domestic bond market is seemingly doing very well. But we have, situations where we've actually, gone out to do a lot of issuing of international bonds. And Nigeria isn't the only country that's done that. There are other African countries. But why is it like a preferred thing now? Why do African countries, including Nigeria, issue international bonds?
Okay, I think I'll take it from two perspectives. You mentioned that the bond market is doing well. I think doing well in the perspective of liquidity, in the perspective of deepening the market, I think we've come a long way, particularly when you track it back to, like, say, 2005, when the bond market was still very shallow. Yes, the market capitalization is in excess of 5 trillion.
Right.
We've also seen significant interest from the foreign investors. For example, JP Morgan, late last year, actually included Nigerian benchmark instrument into his emerging markets bond index. We saw the same thing March this year from Barclays, which is why I said deepening from the perspective of deepening the market and liquidity-wise, we've got some attraction. But I think the important thing that we have to look at here is that when you borrow in the local market, there's something we call the crowding out effect. Crowding out effect. Okay. And what I mean by that is the fact that the more the government borrows, because people see the government to be more credible, and that's why typically we see the bond to be risk-free instruments, in the sense that, especially if the government is borrowing in the local currency, in Naira, for example, the worst thing that can happen is to print more money, for example, meaning that the government is not likely to default on its obligation. So the more the government continues to issue bond, the more and more investors get attracted to that government instrument as against giving their funds, lending their funds to the private sector. And of course, we need a balance between government borrowing and the private sector borrowing. For example, in 2010, when the government borrowing did peak at about 1 trillion Naira, we the government's borrowing was up to like almost 1.3 trillion naira in 2010. We saw significant crowd-out effect because even banks were actually starched of liquidity, because more and more banks actually wanted to buy more and more government bonds as against lending their funds to the private sector. The same thing applies to even the PFAs. Nobody wants to buy a corporate bond. No, everybody wants to buy a government bond. Even the banks wants to invest their money in the government securities.